Sorry for the delay again. That was a connection issue I had. All right, let's see who's here. There's a couple of you. So I'm going to pick up where I left off. Finish these notes, answer some questions, solve some of the problems that I introduce or that I sent you. And then get to the new material. So, how many of you have worked with WACC before? Oh, that's not what I wanted to say. How many of you have worked with WACC before? So we talked about the return computing the expected return to an all-equity firm. But what if a firm is not an all-equity firm? What if it also issues debt? So it finances with equity and debt. A firm that is financed by equity and debt is known as a leveraged firm. Leveraged. So the assets of the firm should be balanced by, should equal both the equity and debt of the firm. So what's owed? And we then can speak about the value of the firm being the same as the value of equity plus the value of debt. So what's the value of equity? The value of equity is the value of stock outstanding. And the value of debt is the value of outstanding debt, or the value of bonds. So I'm going to spend a few pages here reviewing some of the terminology and discussing some of the players or the stakeholders and the symbols I'll use to refer to them. So S is the market value of outstanding equity. RS is the return on equity. So this is for each dollar invested, this is a return to stockholders. And then a measure of the systematic risk of equity would be beta S. When it comes to bonds, B, big B, capital B, represents the market value of outstanding debt. RB is the return to bonds. So this is the yield to maturity on debt. You return to maturity, return to bondholders, known as the cost of debt. And beta B is the systematic risk of debt. So this will represent the return per dollar invested to stockholders, and so it's the required rate of return for the firm, because the firm must pay stockholders this return. And the return to bondholders is RB, and we call that the cost of debt. But this goes to stockholders. This return per dollar invested goes to bondholders. But what if an investor is part stockholder and part bondholder, and although they could be in a different proportion, invested in a different proportion than the firm is invested or financed by stock and debt, we're going to talk about the return to the average investor in the firm. So this represents the return to assets, or return to an investor that's partly invested in stocks and partly invested in bonds in the same proportions as the firm. So what am I talking about? I'm talking about the shares, or the weights. Remember that we talked about weights for the portfolio. Now we're going to talk about the weights, or proportions invested in stock or financed by stocks and bonds. Since an all-equity firm has only shareholders, the share stocks to the value of the firm. The share of equity finance is 100%. If a firm is all debt, so only issues bonds and has bondholders financing the firm, then the share of debt to the value of the firm would be 100%, making equity 0%, and the share here for debt would be 0%. However, the average invested in the firm, these are their proportions. The proportion of debt and equity are both positive. So this demonstrates, the only thing that you have to remember here is that we call the average investor that hypothetical, theoretical individual investor, could be a firm, could be a person, that invests in the firm equity and debt, just like the firm has equity and debt outstanding in proportion. So we could say that the return to assets, or return to the average investor in the firm, if the firm was only equity, it would just be the equivalent of, because all the investors are shareholders, that return would be the same as the return to equity. And if the firm was was financed only by bondholders, then the return to assets, the average investor, would be just a bondholder, so their cost of capital would be just the cost of debt. But when you have both equity and debt, you have a levered firm, then we will talk about the return to assets as the return to the average investor in the firm, or more specifically, the weighted average cost of capital. So we refer to this as the cost of equity. This is the cost of debt. But if you have both, you have the weighted average cost of capital. Okay, so these are the stakeholders in the firm. So keeping in mind, and see I've dropped the E's, but these are, to remind you what we're getting in the end, are the expected returns to the portfolio. Expected return to the portfolio for dollar invested in the portfolio is equivalent to the weighted average of all of the assets, the returns to all the assets. So this, we've seen this before. This is just like, I don't know if I have it here. No, it's going to be in the other one. But this formula is just like the one with the E's around it. I just use lowercase to drive the point home that these are the required rates of return. All right, so with that in mind, that we have to get a weighted average of all of the assets to compute the return to the portfolio per dollar invested, we're going to use the same principle for the weighted average cost of capital. We're going to call it our assets, and here we have the weights. So this is like the weight for stock and the weight for bonds. Now the only thing we need to discuss that looks a little maybe strange is this term. Where does this term come from? No comments? Okay, well, the fact is, and the reason why there's an incentive to take on, to issue debt, is that the interest payments to bondholders are actually tax deductible. So they reduce the taxable income of the firm and generate tax savings as a result. So we're going to talk about that in the impact on the value of the firm. But right now, it's important to realize that from the perspective of the investor, This is the return. From the perspective of the firm, this is what is paid to the shareholders in the firm for dollar invested. That's for equity. Now, from the perspective of the investor, they make return to debt. So this is their yield to maturity. But from the perspective of the firm, when this is paid out for dollar invested, this is the interest payment made per dollar invested. This can be claimed on taxes, and it reduces what is actually paid out. So it's offset by the tax savings. So since the firm pays bondholders interest payments of RB for every dollar invested, the firm also incurs tax savings of TCRB. So this calculation we've discussed before. This is what it looks like when you claim and reduce taxable income. This is the generated cost savings. You just take the rate times the tax rate times the amount that you're claiming. And this is per dollar. This is all per dollar. So the cash outflow of the firm to its bondholders and the cash inflow to the from the bondholder's perspective for each dollar invested will be RB minus this tax savings. So it simplifies to this amount. So that's why we get this term. So what is that? So that's how we calculate the return when a firm has debt and equity issued. What about risk? What would be the risk of the levered firm? So we talked about, I introduced last class, the idea of the weighted beta. If you can have a weighted return, you can also have the weighted risk. So that's the weighted beta. And here it is. So to calculate the beta of assets, we would weigh each of the betas and sum them. So this is the weighted average of the betas. Now we would have to specify that this is the after tax cost, so after tax beta. So I'll explain what I mean by that, but essentially if I'm going to talk about the after-tax return to bondholders, I should talk about the after-tax beta because those have to match. We match risk, or we trace risk to return through the capital asset pricing model, so they need to match. Now what if, so let's look at this now, and why do we take debt? So debt is a lower return to the cost of debt, RB, will be lower than the cost of equity, and even made lower after tax. Why? Because it represents a lower risk asset than equity is. Now, why? Because we talked about bonds before, because bonds are a contract between bondholder and the firm with some commitment. On the other hand, shareholders don't have a commitment to getting a dividend, and they don't have a guarantee that the stock value is going to go up. So those are the two things that make up the return to shareholders, right? Which we talked about in risk and return. So there's no guarantee to stockholders, which makes it much more risky to invest in equity or to invest in stock, and that's accompanied, by a higher return to compensate them. And on the other hand, investing in debt is less risky because there is a legal claim on the profits that the firm makes by bondholders. So this could be low. This could be even zero. Okay, so that it's not volatile, it's not risky, it's not sensitive to market returns. There could be very little relationship between market returns and the debt issued. So the beta would be low. So let's say it's close to the zero. Then it looks like we could rearrange this and demonstrate that if this is low or close to zero, then, and this is a value less than 1, this weight, then that means that the risk measured by the beta of stock must be greater than the beta of assets. So algebraically, okay, so all I've done is to divide by this fraction, I multiply the reciprocal after I cross multiply. So that's where that term comes from. And so the beta of equity is a fraction bigger than 1 times assets, so this must exceed the beta of assets. So in other words, we are weighing down the beta of stock when we introduce the beta of debt. It dampens the riskiness. So beta of assets is less than the beta on equity. So let's go back to the UAIR case and use the information provided. We introduce some information on debt. Let's see what it says in the case. So once we did all we did the other day, now we're going to introduce so we did all of these 2 questions. Number 3, now assume UAIR is a levered firm, that is, it has debt on its balance sheet. Given that 53% of its assets in market value is financed by equity and 40% with debt, estimate the weighted average cost of capital for UAIR. So here's the information. So this is the amount, the proportion of the balance sheet for equity, and then this one is for debt. So I'm taking it right out of here. So what does that give me? That gives me this amount, 43, you see, 47. The tax rate was 40%. This is the yield to maturity for the debt, and this was the return to equity we computed using the capital asset pricing model. So re-estimating the cost of capital now, we call this the cost of capital, or more precisely, the weighted average cost of capital. It goes down, right? It has to go down because we weigh down the riskiness by introducing debt. That's less risky. So this even goes down. By including debt now, we're making it more likely to accept projects because our required rate of return goes down. So we have two motivations. One would be the interest payments and their tax deductibility, and another is that there's a greater incentive to take on projects. So we can check calculating the NPV, of course, it's even better, it's positive, and we invest. Otherwise, we just have to compare our new return to IRR. Since it's smaller, we still invest. So the next question is, we've done all of this assuming that the beta for the project is, so going to the Bahamas, is the same as the beta for the firm, but that's not necessarily the case. The project and the firm may have different betas. So I have some bullets here. When the project and the firm are not from the same line of business, you should use an industry beta. And so they are in the same line of business. It is airlines. But making this point in general, you could use an industry beta. That could be available. However, that might not be available if you have a startup firm. So you have nothing, it's like a breakthrough industry, something new. It's hard to find data that doesn't exist. So it would be hard to come up with some sort of beta to use. Another point is that the project and the firm may have different betas when the project risk is inherently different, even in the same industry. So it turns out that we suppose that the Bahamas line is more risky. Actually, the beta is now, that I'm going to give you, is very high. It's 5.5. Although in the case I had a smaller number, somehow I changed it to 5.5. I actually said 3.5 in the case, but we made that 5.5. Okay. So we're going to calculate the CAPM again using the new beta. Even though we went through the trouble of getting it in our calculators yesterday, I'm going to use the new proposed beta with the information on historical returns that are recent and the current T-bill rate. And look at this. Our expected return jumps to 16.28. So this is the new required rate of return for equity per dollar invested. So this is the required rate of return of stockholders in the firm. So recalculating WACC with this much higher return, putting this number in, recomputing what I just did, but changing this number, the required rate of return becomes 10.33%. So this is the cost of capital. And what happens now? So what was the internal rate of return? Let's see. Let's remember the internal rate of return was 10.26. So this was the measure of return of the project itself, and you compare it to what's required, and now we don't make it. So if the risk is of the equity is adjusted to such an amount, like 5.5, the beta becomes 5.5, that moves us to not invest in the Bahamas project. It's not profitable any longer. Any questions? So the last point, and I've repeatedly said this, what is the effect of increasingly low T-bill rates on investment decisions? What do the T-bill rates affect? Well, the capital asset pricing model, right? So remember the model. I'll use this form. So T-bill rates have been unprecedentedly low in the last 10 years, almost decade. And that keeps this low. By keeping this low, it depends what we use here, but if we keep this low and we use historical returns here, this would keep the expected return low and make projects, the required rate of return would remain low and projects more likely to be accepted. So it's an incentivized investment if you believe that the CAPM holds. Remember, we used historical data for this piece, and then this one we just used the current T-bill rate. Okay, so that's it. I just have one thing to add, and we'll do some exercises, and that is what we would do if we had another class of investors in the firm. We would still talk about the weighted average cost of capital, but we would include the other class of investors. Here are the other investors. The preferred stock may be issued. Preferred stockholders have more of a commitment than the common stockholders. They pay a little bit more, but they expect a higher return, or more likely return, a less risky return. So preferred stock pays a constant dividend in perpetuity with a commitment from the firm. In contrast, dividends on common stocks are not constant over time. Interest payments on bonds are similar to that of preferred stock, that there's a guarantee, though they are finite payments. So we would include another term here for the weighted average cost of capital, and we would also have to include the asset valuation of preferred stock in the valuation of the firm. So let's do an exercise like this, and then we'll go backwards and solve problems that you might have. Just hold on. Okay, it should be there. So I sent you these questions. I mean it's one question, but it's a big answer. It's a long answer. So we have the very question here. Did any of you try it? Did you attempt the problem? Okay, nobody's worked on this before, so should I go into it? Or do you want some time? Oh, I'm going to jump in. So presumably you learned this before. I might make it a little more detailed than you're used to, but you should have learned about the WACC before. If not, that should be fine. You just have to do a little bit more, it's just a steeper learning curve if you've never seen this before. So NC Core has long-term debt, so 20-year to maturity, with a book value of $736 million, preferred stock of 1 million shares with book value of 100 million, and common equity 44 million shares with book value of 1,421 million, in other words, $1.4 billion. The interest on its debt is about $72 million per year with annual payments, and the debt is currently worth $834.18 per $1,000 bond. Preferred shares are selling for $85. You see they're more valuable than common shares because of that guaranteed return. Or that commitment to a return, let's say that, because nothing is guaranteed yet, but it's a commitment. Common shares paid a dividend of $4 per share this year and sell for $32 per share. Preferred shares are selling for $85 per share and pay a constant dividend of $6 per share. The common dividend is expected to grow at 5% per year. The income tax rate for NC Core is 50%. Find the WACC. So where should we start? So I have preferred stock over here. I'll put common stock here and debt over here. So beginning with the preferred shares, the book value, you are told, is $100 million, and there are 1 million shares outstanding. However, the market value per share is equal to $85. Now you're told that the dividend per share, so let me highlight this information so you can follow along. On preferred shares, we have this information. So I've just taken the information in yellow and transferred it here, or consolidated it over here. So the dividend is actually $6 per share. So since we know the price for constant dividend in a constant dividend indefinitely could be valued using this perpetuity, that means that we can solve for the return to equity in an easy way. So this is sort of using, well, anyway, we're just using the perpetuity formula. It's kind of like the dividend growth model, but there's no growth here, so that's not a really good comparison. So this is going to get us the return to preferred stockholders. So this is going to be 7.0588235. And you should store that. So let's store in 1. So what we need from each of these assets is the return and the valuation, right? Because that goes into the formula. We need the return and the valuation. What's the value outstanding? Market value of outstanding stock. Commons, in this case, preferred stock. So what is the market value of preferred shares? The market value per share is known, and the outstanding shares is known. So it's going to be $85 million. No comments? Nobody's there? Anybody home? You watching me? All right, let's just continue then. So we have, I'm going to call this the return to preferred stock that I've got from this calculation, and I've used the information that I've been given and use a valuation of present value of future cash flows to find out the return. So I want to make sure this looks like a P. All right, now, oh, that's not a good line. Now let's do this for common stock. Let's go through and get the book value. And the market value, and then we're going to get the required rate of return. This is crooked. So let me erase, and let's highlight the information on common stock. So the information on common stock that's the information on common shares. Paid a dividend of $4 per share. And sells for $32 per share. The common dividend is expected to grow at a rate of 5% per year. Where's the book value? Do I have it? Oh, it's up there. So the book value is $1 billion. I'll say billion. And there are 44 million shares outstanding. So you see there's much more common stock. That's the idea of it being common, and they're less preferred shares because it's more exclusive. The market value per share is currently $4. No, sorry, it's $32. That's the $4 is the dividend. So the market value per share is $32. You're told the dividend is $4, and this is going to grow at 5% per year. So now we want to find what is the expected return on common stock. Now we can do it the same way, but a different formula. Now it's going to be like this. And so where our interest rate will be the required rate of return we're looking for, we want to solve for this. Just like we solve for this here. We want to solve for that. So let's plug in what we have. $32 for I and 0.04. So when you solve this, the return to common stockholders will be the solution here. So let me just do an intermediate step. So this is using the dividend growth model. So I estimate the required rate of return. When you calculate this, it's pretty high, 18.125% UC. So common stock has a much higher required rate of return than preferred because it's less, there's less of a commitment from the firm to pay common stockholders. Also, it's a lower rate. It's lower payout. So what else do we need? The market value. So now the market value is equal to, let's put that one in storage too, by the way. And the market value is equal to 44 million shares, or let me put the value per share first. So the market value per share is the $32 times $44 million shares so it's going to be $1.4 billion. All right. And finally, let me move this over. So let's look at the debt now, the last piece. So book value. Let's clean up and highlight the important information. So here's the information on the book value of debt, the interest paid on its debt, and the value of debt with the face value. And face value, as I mentioned, is usually $1,000, sometimes $5,000. But if it's not stated, you assume $1,000. All right. So given that information, the book value is $736 million. So what number of bonds are outstanding? Since the face value was 1,000, that means that you need to divide 736 million by 1,000 to know how many are outstanding, because it's the face value times the book value, times the number of bonds. Let me write this clearer. Let me do this again. The book value should be equal to the face value per bond times the number of bonds. So that means that there has to be 736,000 bonds outstanding. The market value, you're told, per bond is $834.18. I guess that's per bond. You're also told that the interest paid is equal to $72 million. So how does that help me? what's the coupon rate? A coupon is found by taking the rate times the face value, right? This is the coupon paid. So if I take the total of the coupons paid, and as though they are the interest paid, and divide by the total book value, so of all the bonds, this should give me my coupon rate. So this is per bond, but this is overall. It should be the same, should be consistent. So I end up getting that the coupon rate is equal to 72 million divided by 736 million, or a rate of 9.783. Now I should put that in storage as well. Store 3. So I have notes of what's in my calculator. But let's see if I need to keep that there, because what I'm going to do with it is use it to figure out the payment, and a payment should just be 2 decimals anyways. So let's figure that out. So how do we find out the payment? Going back to the payment, it's equal to C times $1,000 so it's just going to be $0.9783 times 1,000, 0.09783. Which is $97.83. So since I just need the dollar amount, because that's all that's going to be paid, I'm just going to leave it like that. I'm going to use that. Now this bond is a 20-year bond, 20-year to maturity. And we have all the information we need now to estimate the yield to maturity. So let's put the bond formula together. So this is just the regular bond formula for coupons, bonds. But I haven't worked with semi-annual. They're annual coupons. It's a simplifying assumption. I'm just double checking what it says. Annual payments. Okay, so it does say annual payments. So here we are. We can put this information into the calculator. 20 into n. RB is what we want, so we leave that blank. Then we put in 834.18 as a negative into PV. If that's purchased, then 97.83 would be a payment. That should be a positive into payment. And then of course we have to put $1,000 face value to be received into FV, and then ask to compute the interest rate, and you will get what is the return to bondholders or cost of debt. And you can override what you have in store 3 and just put this number that you get, 12,003 4590%. It's a very high rate of return. So that's because this is when it's not necessary. We're not going to use it again. Not necessary for future calculation. All right, you guys have been extremely quiet. So I will leave you to finish. Because you need some practice and I'm not sure where you're at. I will send you the solution, so you need to wrap this up. What do I mean? I mean you have to now compute the WACC. You need the market value. You have RB, but you need the market value of debt because you have the per bond. Market value, but I didn't put the total market value. I should put that above. Let's move that in here. I guess I put it at the bottom for all the others, so that should be fine. So this is what I'm going to use next. So market value would be the 736,000 bonds times $834.18 per bond for a total market valuation of $613,956. Well, $480. So 613,950. Sorry. It's not 613,000. It's 613,956,480. And this is the information that I need for the next piece. Trying to make that smaller, doesn't work. So let me take these down. So this is the final set of information that I need. And I'm going to put this together in my WACC formula. What's the WACC formula after all this? Did we forget what the WACC formula is? From the top. It's here. So you have everything you need. This is SP. This is SC. And I guess I use RC. I changed notation. Okay, so yeah, I use RC instead, common rather than share because, or stock, because there's two types of stock. And this one is obviously RB, and so this is B. TC is 50%. And that's all you need. So finish this yourself the WACC should be 14.1459024%. Okay, so you can work on that. Let me know how that goes, and I'll send you the completed clave. All right, so that's all I want to say about that. Let's look at other exercises. I guess there's two more I wanted to look at. The last two that I gave you. Yeah, I'll just work on this one a bit. So document 520. Yeah. So this is review 5. This is document 520. So I'm going to give you 5 minutes to read that. See if you can do anything without me. And then we'll do it together. Okay, you ready? So what we're going to do here is work with the security market line that we discussed yesterday and create portfolios by combining the risk-free T-bills and the market portfolio to create a new portfolio. So we begin with $4 invested in the market portfolio. So $400 of a total of $1,600 is invested in the market portfolio. What does that tell me about the weights and the risk and return of the new portfolio? First of all, $400 divided by 1,600 will give me the weight on the market portfolio. So that's going to be 1/4 or 25%. Because I know the weight of the market portfolio and the weights must sum to 1, that means I know the weight on the risk-free T-bill. So I have the weights. I can calculate the weighted beta and the weighted return. That's it. What's the weighted beta? The weighted beta is the beta of the risk-free weight times the beta of the weight on the risk-free asset times its beta plus the weight on the market portfolio times its beta. Now this simplifies because we know that this is 0. Well, let me be a little more explicit here. This is 0 and this is 1. So the final result reduces to just XM. So the risk of the new portfolio depends completely on how much is invested in the market portfolio. So the sensitivity of the new portfolio is completely dependent on the proportion of risky asset investment. And then the return for the new portfolio is the weighted average. So keep in mind, I don't have to write an E when it comes to the risk-free because it doesn't have variation, volatility. So that is the weighted average. And then this is, remember, the weight for the risk-free is 75. The return is 4%. The weight for the market portfolio is 25. And the expected return on the market portfolio is 12%. So you put that all together and you get that the new asset has a 6% expected return. So we mix together risk-free T-bills and the market portfolio to get a modest return, right? Because it's somewhere in between those, but closer to the T-bills because we invested more in T-bills with a lower risk than the market portfolio. Closer. It's just a fraction. So this is in general, this will be the case, this formula will apply when you're mixing the risky assets represented in the market portfolio with the risk-free one. All right, that's the first one. What about part B? So you're told to ignore part A, and instead we're going to short $800 worth of T-bills and take the value and put it towards the market portfolio. What is that going to look like? When we short T-bills, we understand that we have to return them at a later date. So we use negative 800 to denote the T-bill investment. And so that actually gives us negative 0.5 as the weight on the T-bills. And we put that towards the market portfolio. So the weight on the market portfolio is 1.5. So using the logic from above, since the beta captures the sensitivity of this portfolio's returns to market returns, it's just the fraction invested in market return. So actually this is quite high, 1.5. And then to calculate the expected return on this portfolio, we use the weighted formula up here, the weighted return, and we get negative 0.5 for the risk-free times 0.04 plus 1.5 for the market times 12%. And you see this is so much higher than the market portfolio itself. We've expanded beyond the 12% by shorting T-bills. Higher risk than the market portfolio, right? 1.5 more sensitive. But the return is higher as well. Okay, now again, ignore parts A and B and instead assume Y has an expected return of 26%. So in other words, I know this one, but I have to find all the weights. Now that's really high. So it's probably going to be, it's going to be short selling again. So it's a matter of finding what that weight is. So let's try it. I guess the first thing you would think of is to set the expected return formula to 26%. But that's too many unknowns, right? We have two unknowns, so we should get rid of one. So what we can do is we can write one in terms of the other and solve. So I can write I'll write this XF in terms of XM. And then solve that for XM. So that's going to be 0.26 equals 0.04 minus 0.04 XM plus 0.12 XM. So that's 0.08 XM. I skipped a few steps there, but nobody's complaining, so I will continue. So what you get is that this is negative 2.75, and like I said, it's really high. Well, that return was really high, so you have to have a lot invested in the market portfolio, and you'll do that by short selling T-bills and using the proceeds to invest in the market portfolio. So that's negative 2.75. So if this is negative 2.75 and the two weights have to make 1, then XF must be something looks sketchy here. Oh, what did I do? It's not a negative. This is a positive. It's the T-bill rate that has a negative on it. There we go. No, but it is a negative. Let me see this again. Let me try this again. All right, yeah, this is a positive. That's what went wrong. Sorry. And that works. I'm looking for the negative, but it's not here. It's with the T-bill rate. Anyway, this is really high. So it's 2.75 for the market portfolio's weight. And so that means XF is 1 minus 2.75. Which is a negative. And since we know the weight on the market portfolio, that is going to tell us the beta of the new portfolio Y. Remember, because it just matters what fraction is invested in the market portfolio that determines the beta. Because there is no contribution of risk from the T-bills, right? Because beta is 0 there. So we're almost done. We have to just figure out the dollar amounts in T-bills and the market portfolio. So how much was invested? Well, it's a weight, right? So it's XF times the $1,600, or negative 1.75 times 1,600, which gives, so it's short selling $2,800 worth of T-bills. You can do the same for the market portfolio. So all of that is put towards the market portfolio for a total of $4 million. $4,400 invested in the market portfolio. So first, I give you information on that's going to help you figure out the weights. Then I ask you instead to find the weights using information on the expected return. What if I give you information on the standard deviation of the market portfolio? Can that help you determine the proportion that's, well, I want to find different things. I want to find the standard deviation of the new portfolio, the beta of the new portfolio, and the correlation between the new portfolio and the market portfolio. And I begin with the statement of the variance of the new portfolio, because it's a combination of T-bills and the market portfolio. But notice this reduces down quite well because there's no volatility in the market portfolio. That's 0. Also, that's going to make this 0. So all you end up with is this term for the variance. So if you take the square root, that is the standard deviation of the new portfolio. It's just a matter of what fraction you invested in the market portfolio. That will be the standard deviation of the new portfolio, because again, the risk-free rate doesn't introduce any volatility. The risk-free return does not contribute volatility or variance. So this turns out to be easy to calculate. This is just XM. So you're told that 35% is invested in T-bills. So this is 0.35, which makes XM 0.65 because they have to sum to 1. So this is 0.65 times the standard deviation of the market portfolio, which gives you 0.208. So that's the standard deviation. And what about the beta? It's still true that the beta of the new portfolio is equivalent to what the proportion of investment was made in the market portfolio. So this is simply 0.65. And then because the volatility of the returns in the new portfolio only depends on the volatility of the market portfolio, the proportion of the market portfolio, then the correlation between returns on the market portfolio and the new portfolio is just 1. And I have in the solutions described how that could be using the formulas. But anyway, if you think about it that way, is there correlation? Where's, how do they vary or co-vary? Well, the volatility of both is determined by the market portfolio, so the correlation is 1 for 1. Then I have some more questions you guys can try. And on the second page, I have a problem just like the one we did yesterday that you can work through about pricing stock and determining whether they are under or overvalued, and then what course of action should be taken. So that's all I'm going to say about risk and return, and I'm going to send you the last portion of material for us to discuss. Yeah, I have to send them. Okay, hold on. All right, I'm just sending you the last set of notes, and I'll send you the problems later. I think my internet is messed up. trouble with Outlook. Okay, so I sent you the last set of notes. So for the test, this weekend, the test will include Unit 5 material, like up until, I think it was just Unit 5 because I tested, let me think. I tested Unit 4 already, right? Yes, capital budgeting. Okay, so the test this weekend will include Unit 5 material, and the final exam will include everything the final exam will include everything okay? That is including Unit 6 material that I'm going to cover now and tomorrow. Okay, questions? So Unit 6 material is about how and whether it matters the relative proportions of debt and equity. What matters from the perspective of the firm, we always learn, it matters what shareholders think, right? Are the operations of the firm profit maximizing from the shareholder perspective? But value of the firm is composed of, the value of assets in the balance sheet is equal to what is owed to investors or financiers of the firm, the bondholders and the stockholders. So what role does debt play is what we're going to get at. And do shareholders, how do they perceive debt? Well, an all-equity firm that takes debt needs to consider the impact on shareholders. So what do shareholders care about? Do they care about their equity, or do they care about the impact of such a change in capital structure on the value of the firm? So do they care about maximizing the pie, or do they just care about their portion of the pie is the question. That's the first question. So should the management of a firm aim at maximizing the value or at maximizing shareholder equity? And second, well, the answer is going to be that they care, that they do care about the value of the firm. So if that's the case, then the second question is, what is the best or optimal debt to equity ratio that will maximize the value of the firm and in turn the value of equity? So there was much ado about this in the research arena, and there were two predominant financial economists that developed a theory known as M&M. M&M for their names, Modigliani and Miller. So I'm going to review the theory. Has anybody ever learned about M&M theory? It's going to help us answer these questions. So I'm going to begin with this exercise. If you can follow along, you might have to rewatch this explanation. So it's a demonstration of the logic used to answer this question. Should management maximize the value of the firm or shareholder equity? So we begin with a firm that is unlevered. That means there's no debt. So it's an all equity firm. When you see a U, that's an all equity firm. Thanks, Saviana. So there's no debt, and equity is valued at $1,000. There are 100 shares outstanding, so then the price of each share is $10. You got that? So that's market value. That's market value. Their stock holding. So what we have is debt with B, that's 500, which could have an impact. Now, I'm not going to talk about exactly what impact it has. It could be perceived as good, it could be perceived as bad, because from the market's perspective, debt has a benefit because it does reduce taxable income to the firm, right? Interest payments are tax deductible. So there's something there. However, shareholders as residual claimants to the profits of the firm have to take a backseat to bondholders who have a commitment from the firm to be paid first. So that could be perceived badly. So I don't know exactly. I don't give you much more of the information, except that it could be the worst thing in the world, it could have no impact, or it could be the best thing in the world. So I present 3 scenarios. So whatever the case, let's see if we can have a consistent answer. So in the best case, same, and the worst case, debt of 500 is issued. And the original value of the firm is 1,000. So let's say the value of the firm goes up. Okay, so now this L stands for levered. So this firm has debt and equity. It's called a levered firm or levered. So let's say it's the best thing that happens. So its value goes up to 1,250. In that case, we could calculate shareholder equity. Shareholder equity is 750. It went down to 750. However, remember that valuing stock is not just market valuation. We don't just look at the impact on the market value of the firm. We also look at their dividends, right? So remember that we took those $500 and we gave it back, or we gave it to the shareholders. So let's look here at the impact. So the value goes up to 1,250. The capital gains is actually a capital loss. They went from 1,000 to 750. But en masse, there was $500 in dividends distributed. So this is the payoff to shareholders after the restructure from all equity to a levered firm. So this is why shareholders are better off. All right, it's not because of this loss in the valuation, it's that they actually receive this dividend. Okay, so that's the best case. In the best case, it looks like the value goes up of the firm. At the same time, the value or the payoff to shareholders is positive. So they reinforce each other. In this case, the value of the firm coincides with the value increase value to shareholders. What if there is no change? So in the no change case, debt is issued of 500, the value of the firm remains the same, and then that means that the value, the equity is worth $500. Remembering the payoff to shareholders of 500, even though this is a capital loss because we've gone from 1,000 to 500, we net out no difference. There's no increase in payout. There's no decrease. And in the worst case, imagine that the value of the firm drops to 750. In this case, we compute that equity would have to be, so all I'm doing, this equation, you see, because where does this equation come from? It's because B plus S must be V. I'm using that property there. So V is equal to B plus S. So I'm using it to solve for the value of equity. So then that leaves the 250 to shareholder equity. Let's put it together with the dividends. This is a loss of capital loss of $750. It's not enough to the dividends are not enough to offset the loss, so there is a loss to shareholders. So when the shareholders lose, the value of the firm goes down. These are parallel. These are in tandem with each other. So when the value of the firm is high, so is the value of shareholders. When the value of the firm is low, so is the value of shareholders. So in this sense, shareholders should be concerned with the firm's value. So they do care. They do care about what is going on with debt. Whether the firm issues debt or not, it matters to them. Whether it makes it better, the same, or worse, it impacts them directly. Well, indirectly, let's say. But it impacts them in the same way, same direction. So Modigliani and Miller addressed the second question. So we answered the first question going back. The first question was, should management aim at maximizing V or S? Well, they should care about V because the shareholders care about V. So that's the answer there. Second question is, so then if that's the case, what ratio, like what is the relative ratio of debt to equity that will maximize the value of the firm, in turn the value of equity? So what should that be? So Modigliani Miller have created an abstraction of the real world to go from a scenario where it doesn't matter how much debt is issued to a more realistic scenario. So they have a number of steps. They begin with an extreme amount of assumptions, and then they start relaxing the assumptions to make the setting a little more realistic. And the first proposition of M&M is the case of no taxes. Now we have to introduce this because we want to remove the incentive or the attractiveness of debt, right? Because if there are taxes, then interest payments are tax deductible, and so it's attractive to the firm and even the shareholders to have debt because it reduces taxes and potential profits paid to them. Are you kidding me? I just realized you didn't see any of the things that I talked about. I lost connection. Do I need to do this again? Because I lost connection. I just noticed. Did you follow along with what I was saying, Daviana? Darn. So I was itemizing all these points. Were you able to follow without seeing my cursor? So you know what I'm going to do? I'm going to stop there. Tatiana and Daviana, I'm going to repeat this tomorrow. You guys can work ahead, read the notes, and maybe feel a little more comfortable. But I'll start here tomorrow because I got cut off and you didn't see everything I had to say. So I'll repeat this tomorrow. And then talk about M&M. And we'll focus on M&M tomorrow. So this stuff is for the final exam, and it's not hard, but you need to be walked through this material. Is that all right? Okay. So I'm going to send the last chunk of exercises that go along with these notes. You guys continue to work with the materials I gave you. Let me know if I miss sending you any of the solutions. I think there's just 2 more I owe you. And otherwise, that's it. And the test will be completely on Unit 5. So work on those exercises in preparation, all right? All right. And Daviana, let me know if you've sorted out things for the textbook. I'm not sure what's going on with the representative. Maybe I can give her a call. Let me know by email what happens with getting the textbook access. I did send you the instructions. Follow the instructions. Let me know if you didn't get the instructions. I sent them at the beginning of the course. Maybe they went into your junk mail. Okay? So take care. Thanks for being here. So you're looking for the temporary access. I think temporary access is only for 2 weeks. Bye. Daviana, write the the representative and see if she can help you. If the temporary access is not there, it's just because she needs to charge you for, even though it's a week, to get access. I don't know. You should have more than 3 weeks access to that textbook, though, if you buy it now. Okay, bye-bye. Good day.